Welcome to the Monday Futures Market Outlook for April 1st, 2013. This is Patrick Sresna. As always, we start off with a chart of the U.S. dollar index futures, and the U.S. dollar continues to hold up along the top end, but certainly is hesitating making any further progress. This continues to be a direct play on the euro, and if for whatever reason the euro had a catalyst that created a very rapid drop below the 127 level, that certainly would leave ample room for the U.S. dollar to yet shoot up to that 84 and a quarter level up above. The one thing here is that there are substantial supports on a number of currencies. The yen is holding recent lows. The pound is already coming off of its low. We've seen lows in things like the Canadian dollar, and if for whatever reason that support that's important here on the euro, which we'll look at in the next slide, does hold, then there's a lot of case to be made that the US dollar has room for a correction lower that could easily make it down to that 81.50 level on the downside. And so we'll be watching this key transition level and see whether this is the turning point where the US dollar will turn. So when we take a look at that euro, we can immediately identify where those lows came in last November, and seeing that the support is coming in at that level. This is going to be a key moment to find out whether or not the euro is going to have a much deeper pullback, because any break of this support on the down below really does open the floodgate for a drop in the euro that could resemble that of the British pound that occurred earlier in the first quarter. Now, we're not forecasting that, simply emphasizing the importance of the support level, because if the euro does find the support and hold it, we have plenty of room to see retracements back to 130 to even as high as 133 on the upside. We do not believe that the euro is going to begin a new substantial uptrend, simply bounce from an oversold state. So we're going to wait here to see what the euro does and whether it shows its hand as to which trend is going to begin here. Next here, I want to take a look at the 30-year Treasury bond, and this is something that should not be ignored. As a whole, there's been a very distinct sentiment among investors and traders that go on to the media that bonds are very bearish, but yet the behavior of the bond prices has been substantially different. Basically, since November until now, we've seen a substantial downtrend in the Treasury bonds that has actually found some material support along that 141 level on the downside. But more importantly, the price action of the last month has now seen that 30-year Treasury bond rally to the highs and stop the whole trend of lower highs and lower lows. If we have any material breakout on the upside of the 30-year Treasury bonds, this may indicate that risk on, risk off trade for equities may be rotating in an asset class rotation. So we're going to be watching whether or not this corresponds with distribution in the stock market. But the break hasn't occurred yet, so let's watch to see whether that new move begins. Next year, I want to take a look at copper futures, and copper is quickly approaching support lines down along its 332 lows. This is going to be a very interesting moment because copper tends to have a direct impact from currency movement. So the fact the U.S. dollar is topping may in fact be in one degree or another suggesting that copper may be bottoming. So we haven't seen any formations or anything that suggests that copper has seen its low, nor that it is suddenly a buying opportunity, but we are approaching very key support lines where something like that could occur. We're not too ambitious to be here just yet because these types of things can take even a month or more to develop, and we probably have many more weeks to discuss how the bottom of copper is developing, if it is even at all developing along those lows. But watch for that the bottom of copper to probably correspond with a top of the US dollar. So the euro and the US dollar will play an important role here. Next year, I want to take a look at crude oil, and crude oil has substantially strengthened off of its $90 low. We've now seen actually even Fibonacci retracement levels have been exceeded. This now really does open the window that crude oil can strengthen all the way back to its highs from January, or even its September high up around the 102 level. At this stage, we're not overly excited about the upside of crude oil, but clearly actually the sell cycle has been neutralized, and far more range-bound price action is definitely possible. We're going to again be watching the way it behaves as it approaches those previous highs. Next year, I want to take a look at gold futures. And gold is at a critical moment. We've now seen testing of those lows that were put in last summer, and a lot of different things suggest that the current downtrend has at least stalled, but we have no evidence that a new uptrend has begun. This is going to be a massive transition thing if it occurs. Really, this consolidation may end up being nothing different than what we saw back in January that ended up breaking down. But at the same time, we want to see whether or not gold can muster up an actual break to the upside. If we see any legitimate price action above 1620, it would indicate that all those people that were too bearish gold might get squeezed out of their short trades on gold and actually see a good counter rally back to the upside. But again, we have to see price action above 1620 in order to have any confirmation that that is the trend that's developing. The same regard, if we had any breakdown to the downside, we could have a very quick and rapid drop down to 1550, if not even 1500 on the downside. So we want to remain cautiously optimistic, but still relatively neutral, and let the actual breakout queue actually show us where the trend is developing, and we'll trade in that direction. Next year, I want to take a look at the S&P 500, and we continue to have this uptrend in place. The one thing that I continue to be concerned about as we approach these overhead resistance levels is that the market breadth is deteriorating as we have less and less stocks participating in this rally, which is slowing the pace of the progress higher. But more importantly, a lot of the international equity markets have already seen their short-term highs and have already started consolidating. And it really, in the end, is now the U.S. markets that are sort of moving higher on their own at this point, and that should be something that we don't ignore. And at some stage, this overbought state of the market will probably have to go through some sort of a healthy market correction. So let's watch to see how this develops up here. But we continue to believe that the risk reward is really bad up here. Not that the trend has changed, but rather the amount of risk you're taking for the further upside is not attractive to us at all. When reviewing our key intermarket observations for the U.S. dollar, we remain a risk-reward proposition very average. The reason here is we're staying with average is that we don't believe that there's much upside on the U.S. dollar, but at the same time, implying that there's a lot of downside on the U.S. dollar index would imply that the euro has a lot of room to rally, which we don't think is the case either. At some stage, if the U.S. dollar is a proper pullback, we will consider re-engaging that as a good proposition to buy. We also remain average on our rating of commodities, as gold or copper and other commodities like that have not proven that a short-term low is definitively in. We want to change that to a good proposition, but that's still not really there for us to feel confident enough to change that. We are actually cautiously optimistic bonds. We don't believe that there's as much a downside as everyone is expressing, and we do believe actually that there's plenty of room for them to gravitate to the top end of their ranges. As for both U.S. stocks and global equities, we remain poor of the proposition, and recognizing that there is an uptrend, but simply that the amount of upside potential versus the risk you're taking is simply not at all attractive, and we simply are continuing to advise to reduce exposure. That was your Monday Futures Market Outlook. Thank you for joining me.